Riding the wave. Athabasca Oil's post-pandemic strategy. Athabasca Oil, a Canadian energy company focused on thermal oil production, has navigated the turbulent waters of the energy market since the pandemic. Emerging from a period of uncertainty, the company has embarked on a bold strategy, choosing to distribute 100% of its free cash flow to shareholders. This approach, while potentially lucrative for investors, carries inherent risks that warrant careful consideration. The decision to prioritize shareholder returns reflects Athabasca Oil's confidence in its ability to generate consistent cash flow. The company's operations are centered in the Athabasca Oil Sands region of Alberta, Canada, a vast deposit of bitumen. This heavy crude oil requires complex and capital-intensive extraction methods, primarily thermal oil recovery. Thermal oil production involves injecting steam into the ground to heat the bitumen, making it less viscous and easier to extract. While this technique has unlocked vast reserves of oil, it comes with its own set of challenges. The cost of steam generation and the energy-intensive nature of the process make thermal oil production particularly susceptible to fluctuations in oil prices. Athabasca Oil's commitment to distributing all free cash flow to shareholders underscores its focus on maximizing returns for investors in the short term. However, this strategy leaves the company with limited financial flexibility to weather future downturns in the energy market or invest in long-term growth opportunities. Investors considering Athabasca Oil must carefully weigh the potential for high dividends against the inherent risks associated with the company's business model and the volatile nature of the oil market. The thermal challenge: costs, prices, and volatility. Thermal oil production, while offering access to substantial reserves, presents unique challenges that distinguish it from conventional oil extraction. The process is inherently more complex, energy-intensive, and capital-intensive, making it susceptible to a confluence of factors that can significantly impact profitability. One of the primary challenges lies in the cost of production. Generating the steam required to extract bitumen is an energy-intensive process, often relying on natural gas as a fuel source. Fluctuations in natural gas prices directly impact operating costs for thermal oil producers like Athabasca Oil. This vulnerability to energy price volatility adds an additional layer of uncertainty to the company's financial performance. Beyond energy costs, the price of oil itself plays a crucial role in the profitability of thermal oil production. The high extraction costs associated with this method necessitate a certain price floor for oil to ensure a reasonable margin. When oil prices decline, as witnessed during the pandemic, thermal oil producers can face significant financial strain, potentially leading to production cuts or even project deferrals. The inherent volatility of the oil market poses a constant challenge for thermal oil producers. Unlike conventional oil production, where extraction costs are generally lower, thermal projects require a longer investment horizon and a higher degree of price certainty to justify the initial capital expenditure. Athabasca Oil, with its focus on thermal production, operates in an environment where profitability hinges on a delicate balance between energy costs, oil prices, and operational efficiency. Earnings rollercoaster. Navigating the ups and downs, Athabasca Oil's earnings reflect the volatility of thermal oil production and fluctuating energy prices. High oil prices boost financial performance, but downturns highlight earnings sensitivity. Higher operating costs in thermal extraction amplify earnings volatility. Rising oil prices increase profit margins, while declines can lead to losses. Distributing all free cash flow to shareholders adds to this volatility. This strategy is attractive in good times but limits reserves during downturns. Investors should focus on long-term strategy, cost management, and market navigation. Joining forces: the Cenovus joint venture. Athabasca Oil entered into a joint venture with Cenovus Energy to enhance operational efficiency and reduce costs. This partnership focuses on their combined assets in the Hanging Stone region of Alberta. The joint venture brings together expertise and resources, creating synergies to unlock value. By pooling assets, they can optimize production and streamline operations. This collaboration allows for sharing infrastructure, technology, and best practices. Cenovus brings valuable technical knowledge and operational expertise. Athabasca Oil benefits from Cenovus's established infrastructure and skilled workforce. This joint venture is a significant step for Athabasca Oil's growth and profitability.